December's FOMC decision was a controversial one. Despite intense risk liquidation and instability in the fourth quarter, the Fed failed to live down to market calls for a dovish hike in response to this downside risk, instead maintaining what could have been viewed as a stubborn rigidity. In the decision, while the Fed did express a little more concern, most of the focus remained on economic data that still supported the need to consider additional rate hikes. The interesting thing about the decision was the fact that it came at a time when the president had launched an aggressive assault campaign against Jerome Powell's credibility, with the president demanding the Fed chair consider a less aggressive policy normalization path. And so we don't think it would be a stretch to suggest that in a decision where the Fed needed to hike and was expected to hike, if there was going to be room to lean one way or the other with respect to the accompanying tone, without it really making much of a difference, it shouldn't come as a surprise to see the Fed chair making it a little less comfortable for the president. And so now we await the release of the minutes, which will shed more light on the Fed's thinking with respect to the outlook. Since the decision, there have been more calls for the Fed to come to a complete pause in 2019, and we've even seen the pricing in of the possibility for a rate cut in late 2019, early 2020. Just last week, the Fed chair himself conceded the possibility that the Fed would need to come to a complete pause. This leaves the minutes perhaps painting in a little more of that dovishness that was absent in the December decision, though it doesn't have to be this way, and we could still see a message that doesn't quite live up to the full pause pricing investors have priced in. Last week's ISM data does nothing to encourage the normalization process and was one of those bad news pieces of data that actually inspired investor appetite on the notion that this would force the Fed's hand into adopting that pause mentality. However, things could get a lot more complicated in 2019 if we start to see that rapid rise in inflation that has been long overdue. The jump in hourly earnings in the jobs report warns of this possibility, and should it manifest, all of a sudden we're staring at a Fed that is needing to be considering additional rate hikes rather than feeling good about justifying wanting higher rates because of the healthy economic recovery. We believe this is a headache that has yet to present, but a headache that could quickly blow up into an excruciating migraine. For now, however, we're not too sure how much we can really expect from the minutes and would suggest that the Fed will be wanting to take some more time to see how data and bigger picture risks play out in the weeks ahead. This leaves us recommending euro-dollar levels as a reference point, with a clear break back above 115 or below 112.15 required to offer additional insight into the path forward. Our view is that the path could be one that may in fact give investors the pause they're looking for in 2019, but it won't be enough to translate into that same euphoric wave of stock market demand with policy accommodation no longer what it once was. If we do see additional upside in the S&P 500, we suspect it will find plenty of renewed sell interest ahead of 2650. We do, however, believe this will translate into dollar weakness against the major currencies, with the euro in the best position to absorb a lot of that inflow as all of this plays out over the coming weeks and months. That's all for now.